Welcome everyone. My name is Tanya Clark. I'm with the Kuching Conservancy, and I want to thank you so much for joining us this evening. We'd like to begin by acknowledging that we are on the land of the Anishinaabe, Haudenosaunee, Wendat, and Métis people, and we share the Upper Canada Treaty in the Orillia area. So before we get into the presentation, I just want to remind you to stay muted and keep your cameras off. Just so it doesn't feel distracting during the presentation. And if you have any questions during the webinar, you can put them into the chat box, and you can also send them directly to me if you want the question to be private. And then we'll cover all of the questions at the end of the presentation. So if you haven't already done so, this is a screenshot of two of my coworkers showing you where to click. If you are on a computer, you can go to your top right corner and click on speaker view, and that will just feature the person speaking. And if you are on an iPad or a tablet, you can select the switch to active speaker button on the top left-hand side of the screen. And if you, and then you can slide to the left or the right to see more. And just a reminder, of course, that this presentation will be recorded and available to folks afterwards. So a little bit about the Kuching Conservancy. We are a nonprofit land trust, and that means that we work to acquire and protect environmentally significant areas, and then we work to care for them. And one of the reasons that we do all of this work is for kids like Hudson. He is pictured here in the red sweater, super cute. Hudson is 3 years old, and he is obsessed with woodpeckers. He and his family visit the Grants Woods Nature Reserve regularly, and he loves it there. His mom, Hillary, told me that he runs to the car whenever they're going to the forest. And that is just one part of why I love this work so much. When you protect nature, you're doing it for your entire community, even people that you don't necessarily know. It's for kids like Hudson, and it's for species like this pileated woodpecker. And thanks to our supporters, this forest and other landscapes will be here for Hudson, his kids, and his grandchildren, if he chooses to do that, of course. And this is the impact of almost 30 years of protecting nature for future generations. With the help of thousands of supporters, we help to protect almost 15,000 acres of land. That's well over double the size of Orillia. We've recently protected a new nature reserve, the Cedarhurst Alvar, which is well over 1,000 acres, and it's in the heart of the Carden Alvar, a globally rare landscape and important bird and biodiversity area. And all of this work that we're doing today to protect natural areas is also a promise that we're making for the future. We're promising to protect these landscapes. And I'm going to pass it over to Bob Sullivan, the chair of our Past Presidents Council, to tell you a bit more about how we ensure that our organization is strong for the future.
Thanks, Tanya. I want to welcome Vlad and Candace, and hopefully we can, in the next 40-45 minutes, give you a little bit of an overview of how we might protect this organization for the long term, and also to get the pearls out of something like this seminar would give us. Having taken a number of courses at times over my lifetime, it's always looking for one or two pearls in one of these type of presentations that fits with what we're learning and what we're doing. And I think we're gonna get some because we went really well in rehearsal last week. So hopefully out of this, what we're trying to achieve is showing people that either the charity wins or the government wins, and we would like the charity to win, obviously, and the Conservancy would be the charity of choice. So hopefully we can get this together, and then with the Q&A afterwards, pull it back together again. So thanks, Tanya, and off to Candace, I think, is going to give us a start, right?
Well, I'm going to introduce them officially.
Oh, sorry. I'm sorry, I jumped the gun there. Okay.
That's okay. So our presenters this evening are Candace and Vlad, and we're so grateful for them to be sharing their time and expertise with us. So I wanted to share a little bit about them. Candace has over 15 years of experience in the financial industry and is the vice president at CC&L, Connor Clark and Lund Private Capital. Her practice guides and works with charitable foundations and high net worth clients to achieve their unique financial goals and strategies. Strategic philanthropy is also important to Candace personally, and helping clients identify values in areas where philanthropy can play a role is one of Candace's passions. She understands the importance of giving back to her community and is a current board member of the University of Toronto Alumni Association and the UHN Foundation. She's also a member of the Canadian Association of Gift Planners, leading engagement and mentorship for professional advisors in the community. In her spare time, Candace enjoys practicing yoga, playing golf when not in a lockdown, and tennis, and being in nature with her family and golden retriever Sadie. And also we have Vlad, who is a certified financial planner with over 15 years of experience in the financial services industry. He is currently a team member at the Lazar Wealth Succession Strategies, a financial planning boutique in Markham, Ontario. Before starting his own financial planning practice in 2012, he had the privilege to work in a major Canadian bank, an insurance company, and a mutual funds company in advisory and senior management roles. In his practice, Vlad specializes in philanthropy planning, helping people with disabilities and people in career transition. He's the chairman of the board of High Notes Avante, the registered charity that inspires people touched by mental illness through artistic expression. Vlad is also a member of the Professional Advisory Committee for the Canadian Association of Gift Planners. He lives in Markham and in his spare time enjoys family activities with his wife and 3 children. An interesting fact, Vlad has a bachelor's degree in physics. Welcome, Candace and Vlad.
Thank you so much, Tanya, and thank you, Bob, and thank you all for the lovely, warm introduction, and for everyone else here joining us this evening, welcome. So I wanted to start off on the next slide, Tanya, and I don't know if you're able to make it even bigger because it's showing the next slide. Okay, no problem. So I just wanted to share that one of the most fulfilling parts of my daily conversations with clients is really around their philanthropy and incorporating a more strategic way to give. And one of the most staggering statistics I wanted to start off with is that 85% of Canadians donate to charities, but only 20% of them claim the donation tax credit on their personal income tax returns. And on the next slide, we see this more clearly on the chart, which shows the trends in giving. And this is from the mid-'80s to 2014, which is the most recent study done by Imagine Canada. Perfect, that works. The orange line represents the donor rate, and the dotted black line is the average donation. And what this shows is that the donor base is actually getting smaller over time, and changes in total donations are primarily driven by how much donors give. And from the peak in the 1990s, the percentage of tax filers claiming donations has dropped by 1/3, and the average amount claimed has nearly doubled. And this means that charities are really relying on a smaller number of people for donations. But beyond that, Canadians are not taking advantage of their donation tax credits, and financial advisors really need to work more with their donor clients to find efficient philanthropic strategies to maximize their donations. And we have more recent data on tax years 2017 and 2018. Donations went from 16 billion to 18 billion, and this was pre-COVID. And as we start to get more data on how giving was during the pandemic, leaders in the charitable sector has said it has plummeted. And a lot of smaller charities will unfortunately no longer be there, and we will need to rebuild our charity ecosystem. There's also a digital divide, and that means that smaller charities may not have access to digital giving or employee resources that have kept the larger charities going during this pandemic. On the next slide, I show a dollar pie chart of how the government distributes your taxes. And when I ask clients, is this how you would like to allocate your charitable giving? The answer is no, 99% of the time. So take a look at the segments and see if the charity sectors that are near and dear to your heart are within the pie. Does it have a tiny allocation, or is it even on there? This should be a wake-up call that if you're not strategic or purposeful with your estate planning and charitable intentions, your estate taxes will contribute to what we call involuntary philanthropy. This is the default distribution of your taxes and your estate according to government allocations. And our public policy is that everyone has to contribute to society in some way, shape, or form. And the most obvious one is to pay your taxes. And luckily for us, we live in a country that has one of the most favorable tax regimes to encourage charitable giving in the world. Our system treats giving to charity as close to equivalent as to paying taxes. So it's your choice. Do you want to give to the CRA or do you want to give to your favorite charity? So on the next slide, we look at the same time frame of how private family foundations are giving. And there's still a lot of attention that is needed for some of the funding areas. But since the Kuching Conservancy is an environmental charity, I've highlighted the private foundation giving in the environmental sector, and it is still not a lot at 6%. Environmental charities need to rely even more on individual donors to help their initiatives. And in a few slides, I'll take you through some of the ways that you can immediately start your strategic philanthropic journey. And hopefully the next time you make a donation, you think about being more strategic and doing it more efficiently towards your taxable situation by using one of these strategies that we're going to talk about today. So let's start with a simple chart that a lot of us have seen on the next slide. Perfect. This is most people's wealth savings journey over their lifetime. We work hard to accumulate savings in the beginning, invest it properly so that we can reach a midpoint of assessing when can we retire and how we can use our savings, which will help fund our retirement lifestyle and spending. On the next slide, we break down your overall savings and wealth into necessity spending needs called core capital in the light green. And anything you've accumulated above and beyond your core needs is called your excess capital in the dark green. Now, within your excess capital, you have priorities of where you want to allocate that spending. The most common are for your children, your family, travel pursuits, secondary homes, and also charity. And I hope most of you have gone through an exercise like this before, but if you have not, it would be a great use of your time and efforts to talk and walk through your personal situations with a financial professional. If you don't have someone to help you, Vlad or myself will be happy to talk further. So after you've done this exercise, the numbers will be much more clear to where and how much you can allocate spending into the different areas within your excess capital. On the next slide, we break it down one step further to explore different ways to give through your excess capital to your charitable organizations. And since you're attending the session with the Kuching Conservancy, you'll likely have thought about your vision, your missions, and values, and want to contribute some or sometimes all of your charitable allocations within the environmental space. Once you've gone through this exercise and determined that you have excess capital to allocate towards charity, I've broken it down into two ways to give. So the first is making a direct gift to charity through what I call Checkbook Philanthropy. This means you can give cash directly, you give through your credit card, or you give through monthly mail-in campaigns. And all of those ways are good, but I wanted to talk about a more tax-efficient way to give today. And that is through making direct gifts of publicly traded appreciated securities to the charity from your taxable investment account. Let me expand on that, and I will come back afterwards on how to create a legacy giving strategy. Let's move on to the next slide. So as I mentioned a few moments ago, the Canadian government has created one of the most favorable tax regimes to encourage charitable giving in the world. In 2006, the Canadian government announced some donation guideline changes, and this further incentivized Canadian taxpayers to donate by eliminating capital gains on donations of appreciated securities that are publicly traded. So for example, if you had bought some Apple stock in your taxable account from day one, you'd be very happy with the gains, but also feel a little bit trapped because you have to pay tax on all these gains. And this means that donating appreciated securities of stocks, bonds, mutual funds can be a double benefit that you will receive a tax credit based on your donation, and you do not need to pay capital gains tax. So let's go through an example on the next slide. In this particular example, Sally is practicing checkbook philanthropy, and she wants to donate $50,000 to the Kuching Conservancy. Since it is a credit card donation, she will receive a tax receipt on the donation, and the actual cost of giving is around $28,000, and she will receive a lot of points on her credit card for this. On the next slide, Sally would want to donate $50,000 to the Kuching Conservancy using her Apple stock. She will receive a healthy tax credit, plus not need to pay tax on her gains of the Apple stock, and the after-tax cost of her donation is around $18,000, which is $10,000 less than giving straight cash, and definitely worth it over the credit card points. So to summarize on the next slide, donating appreciate securities is a double benefit in that the donor will not need to pay capital gains tax on the publicly traded security, and that they will receive a tax credit on their donation. If you donate from a corporation, you will have a triple benefit, the two benefits I just mentioned, plus a credit to your capital dividend account where you can access funds tax-free. Now let's move on to the next concept and next slide and talk about legacy giving. If you want to explore leaving a legacy or come up with a charitable strategy with multi-year gifts or want to create a family legacy that lasts for many generations, you should explore setting up a donor advised fund. On the next slide, we come back to the 2 points of how we can use our excess capital in charitable giving. We're now going to focus on creating a legacy through a donor advised fund, which is really a public foundation structure. We just talked about donating appreciate securities in the previous slides, but what if you want to create that positive taxable event, but don't know where to allocate those donations yet? The process of creating your charitable legacy can take up a lot of time, a lot of thought, and part of the solution is that you can donate those appreciated securities into your own donor advised fund and decide on which charities to grant to later on. And this is exactly what one of my clients did when they had a taxable event in selling their business and wanted to take advantage of being philanthropic and saving some tax by starting their family donor advised fund. They added one more level by funding their donor advised fund with appreciated stocks and worked with their accountant to figure out what is that magical number to offset their tax burden. And this ended up creating a very sizable donor advised fund, which had a positive side effect of bringing 3 generations of families closer together. They met, they had more frequent gatherings, and had purposeful discussions of where they wanted to grant their foundation money to. Another one of my clients is a recent widow and had talked about charitable giving with her husband before he had passed, but they didn't set anything up yet. She and herself is in her 70s, has no children, and her extended family does not need to count on her for monetary support. So donating their estate to charity was always on their minds. And it took a few years for her to get her home set up to accommodate her health needs and also mentally come around to figuring out which charities she would like to engage with and working out the details of the gifting structures. And it really took her 4 years in this process. But she did figure everything out and just finalized the details of creating her and her late husband's legacy. Remember when I mentioned core capital earlier today? Well, after the comfort of making sure she was financially taken care of first, the rest became excess capital, and that was allocated towards charity. The process of establishing bursaries and setting up a nature reflection area and other exciting ways to honor her husband's memory takes a lot of time and multiple meetings with the charities, but all worth it to create lasting impact. So in the meantime, she had set up their donor advised fund, funded it with some appreciated securities that have been causing her a headache with all the pregnant gains, while she slowly pieced together all the different pieces with all the different charity setups. Now she's very happy and feels the weight off her shoulders and has set up their lasting legacy and memory in the world. And as for her own estate, she set it up so that it would be distributed into her and her husband's donor advised fund as well. So on the next slide, I wanted to show the internal tax-free growth of a donor advised fund. After you fund your donor advised fund using appreciated securities or cash, or even setting up an insurance policy strategy administered inside of your donor advised fund, you can think of it as a tax-deferred type of account like an Rrsp, a RIF, or a TFSA. And the internal tax-free growth you will receive is tremendous. And as you can see in this chart, that by year 25, the tax deferral can be up to 71%. One of the previous sessions put on by the Kuching Conservancy was on sustainable and impact investing. And in my foundation investment clients, it has been a topic of interest for many years, but it's becoming more mainstream for all clients. And within a foundation or donor advised fund structure, it would be an ideal place to start your responsible investing journey. And given that it is a long time frame and charitable and social impact that you're trying to create, this is really a good place to begin there. On the next slide, I wanted to summarize the simple differences between donor advised funds and private foundations. So a donor advised fund is a simple and flexible way to set it up and to organize all your donations within it. And because of this structure, the costs are very low. That also means a lower amount can be used to start your own donor advised fund and as low as $10,000. However, I would advise you to talk about your personal situation with a financial professional to see if donating straight into the charity makes more sense, or to set up a donor advised fund structure and donate from there. Another great benefit is you can also choose to remain anonymous in your giving through your donor advised fund. We didn't talk a lot about private foundations tonight, but I did want to give it a quick summary in case it is right for your situation. It's a more hands-on and administratively complex process to set up, and you do need to hire your own accountants, lawyers, have a board of directors, which all have their own external costs. And for those reasons, private foundation starting amounts will be much higher. I usually recommend my clients to start there over $5 million or even more before it even makes sense to have this type of structure. A lot of people are also leaving the private foundation structure to go into the donor advised fund side because the family just doesn't have as much interest or the energy to maintain it. So that's another good reason for the switch. And the last point I wanted to make is that contrary to the name private foundation, it is anything but private. It is publicly listed on the CRA website. And given that there are over 85,000 charities in Canada, you could be solicited by all of them. And this wraps up my section at this time, and I would like to pass it to Vlad to talk about some insurance and other strategies to enhance your philanthropic giving.
Okay, great. Thank you, Candice. I'm very privileged to be on the Zoom call tonight with you. I've heard from many people in nonprofit industry that there is an emerging trend when people start turning towards their local, smaller charities. And I support this trend with all my heart. And I'm very happy to contribute to the success of Kuching Conservancy. Candice just described extremely effective philanthropic techniques with investment instruments. And to complement it, I would like to focus on the insurance part. However, before we move on any further in our presentation, I would like to move to the next slide and there stop for a second and think, why are we here today? Yes, we want to know something about extra fees and taxes that we hope to avoid. We want to learn some financial techniques, but why really? Obviously, I cannot answer this question for you, but for me, it all comes down to generosity. Maybe it's a bit naive to think this way, but I consider generosity as some sort of superpower that I use towards those who are important to me, my wife, children, or charity that I believe in. And whether we want it or not, when we leave this world, we create an explosion of generosity. Everything that we were building through our entire life will be going to someone, whether it's our family member, our charity, or some government agency. My point is, I want my legacy to be meaningful. It's not the question of how much taxes will I save, but rather how will I be remembered? And here's the real life example for you from my practice. One of my clients, a woman in her mid-50s, mentioned to me a couple of years ago that she would really like to make a noticeable difference with her life journey. She believes that she actually did it for her family, but not so much for her charities. As you might guess, she is a very responsible family person, and that's why she had a certain monthly budget for charitable giving that she believed was fair for the charities and for the family. In her case, it was $360 per month split between 3 different charities. The question was, how could we make a noticeable impact with that kind of money? I suggested to consider a life insurance policy. We went this way and created 3 separate life insurance policies with benefits over $66,000 each. In other words, each of the 3 charities received the life insurance policy with a $66,000 amount. And up to this day, my client continues paying the same $360 a month for 3 policies combined. The charities were very happy to receive the assignment of those policies, and in fact, 2 out of 3 charities included my client in their VIP list and started inviting her to special events and providing her with special recognition. Of course, it made her feel happy, appreciated, and she finally achieved that peace of mind of making a considerable contribution for her charities without impacting her family legacy. That is why today, Candice and I don't really have the intention to just teach you a couple of efficient techniques. Yes, we'll show them to you, for sure. But what we really want is to demonstrate that your generosity could be substantially enhanced without spending any extra money or compromising your family commitments. Okay, I hope I still have your attention at this point. If not, no worries. I know very well how easy it is to phase out on a Zoom meeting. Let's just shake up for a moment the best way you can, and then move on to the next slide to review another example, just to keep us focused. Let's say we have a 60-year-old woman who regularly donates $200 a month to Kuching Conservancy, and every year gets an annual charitable receipt for the combined amount of $2,400. Assuming normal longevity, this woman will eventually donate anywhere between $60,000 and $70,000 over her lifetime. However, if that woman buys a life insurance policy, the same $200 a month at the age of 60 could get her about $104,000 life insurance coverage that she could donate to any registered charity. As you can see, she doesn't spend a penny more, but simply uses a life insurance policy. This policy substantially increases her gift to Kuching Conservancy, and as we can see on the next slide, provides her with yet additional benefits. She could still elect to get the same annual donation receipt for $2,400, or alternatively, she could elect to get a single $104,000 charitable tax receipt for her estate that might help the estate offset other tax liabilities, for example, on her family cottage. And all this is done with the same $200 a month. Just think of it. Kuching Conservancy get $104,000, gives the tax receipt to her estate, and as a result, her children and grandchildren inherit the cottage tax-free. No extra money spent. Those of you who had the experience of dealing with family cottage inside somebody's estate might remember that normally this transaction is very heavily taxed. Another benefit of donating life insurance policy, it could be done in complete privacy. Somebody's will, well, believe it or not, it's a public document. Every person related to the estate or not can examine and contest it. A life insurance policy does not form the part of the estate. It does not have to be disclosed in the will or anywhere else. This type of donation could be legally done in complete privacy, and nobody will know anything about it ever. And that's not all. Let's move on to the next slide and check what we can do with investment portfolios if we apply the insurance instruments to them. Over the years, a regular investment portfolio might build a substantial capital gain, just like a family cottage. And when the account holder dies, the entire gain will be attributed to a single tax year. In addition to taxes, portfolio becomes the part of the estate, which means that children could face probate fees and substantial time delays. I would like to mention specifically so-called registered portfolios, such as Rrsp, Rrsp, or Lira, because they could create an absolute taxation bomb inside the estate. The balance of the registered account, which could easily be $200,000 or more, is added to the income of the deceased person in a single year of death. If someone earned pension income of, say, $60,000 and passed away having a remaining Rrsp balance of $250,000, their annual income in the year of death will become at least $310,000. And it's important to remember that this amount of annual income triggers the highest marginal tax rate in Ontario of 53.53%, which is, if you just think about it for a moment, it's more than a half of your money in taxes gone. I'll give you some ideas what to do with the RRSP taxation bomb a little bit later in this presentation. But now I'd like to get back to the regular, non-registered taxable portfolio. How could we mitigate the impact of accumulated taxable capital gains? Candice already explained the donation of appreciated securities in kind, in other words, without selling them, which is an extremely effective technique that should be used in this situation. And that is why I would like to focus on two other ways of protecting the money outside of our Rrsp or RIF, which are segregated funds and universal life insurance policy. So let's move on to the next slide. The segregated funds are very similar to other investment funds that you might be familiar with, such as mutual funds or ETFs. What makes segregated funds unique is their insurance nature. Legally, a segregated fund is an insurance contract. And that means that they have a few features that could be extremely helpful in the estate transfer process. And those features are not available in mutual funds and ETFs. And here are some examples. Principal guarantee on maturity and death. You could invest in the market goes up, the market goes down, but you will have your principal guaranteed. No time delays or probate fees, because segregated funds bypass the estate and are not included in probate procedure. How do they bypass the estate? Well, every segregated fund account, even non-registered, can have a named beneficiary. People often make their children joint owners on their bank accounts just to make sure that the money goes directly to children when they pass away. With segregated funds, you don't have to do that. You simply name your children as beneficiaries and keep using your money without their supervision. Assignment of beneficiary creates the opportunity for a complete privacy. Just like with insurance policy, whether the beneficiary is a family member, some important outsider, or a charity, you don't even have to mention it in a will. And the last but not the least, segregated funds provide creditor protection. This feature is valuable for the business owners and those who could otherwise anticipate creditor claims against their estate. All those features make segregated funds the ideal investment for the estate transfer and donation in privacy. Now, let's move on to the next slide and discuss the universal life insurance policy. By the way, is everybody still focused? Do we need another shake-up? Stay awake? All right. Let's do it and stay focused just a little bit longer. Universal life insurance policy is the most inexpensive type of the permanent insurance, which is the great feature by itself. It also has another useful and unique feature, free investment account attached to it. The tax treatment of that account is so preferential that some people even call it a tax-free savings account on steroids. You may add money to it whenever you want at your own pace, monthly, quarterly, annually, or just once in a while. You can select the investment from a wide variety of options that the insurance company provides for you. And any capital gain, dividends, or interest earned in that account remain completely tax-free. And when the policyholder dies, the balance of the investment account is added on top of the actual life insurance payout and given to a beneficiary, again, tax-free. Hence comes that nickname, TFSA on steroids. By the way, if you decide to try it out, nobody actually could stop you from using these funds to supplement your own lifestyle. You don't need to die to access the money inside the universal life insurance policy. Well, so far, we learned a number of key points about the benefits of life insurance. It would be a good time to get back to the problem that I mentioned earlier, Rrsp or RRIF taxation bomb inside your estate. Let's move on to the next slide. The main idea in prevention of the estate taxation bomb is that you do not try to pass your Rrsp or RRIF money to your heirs. There is one exception to this rule. It's your spouse. CRA allows so-called spousal rollover, when upon the death of the first spouse, the balance of their Rrsp or RIF is rolling over to the survived spouse without any tax implications. By the way, the same tax-free rollover applies if you have a dependent disabled child. But if your children are not disabled, the entire RIF balance will be taxed. That is why, if you want to leave some money from your estate to your favorite charity, the money from Rrsp or RIF would be the most natural and most tax-effective way of doing so. We have here 3 options on the slide. So let's go through them one by one. Option number 1, most simple but yet very effective. Make charity a contingent beneficiary. Both you and your spouse keep yourselves as primary RIF beneficiaries on each other. However, you add your charity as a secondary or contingent beneficiary. Contingent beneficiary receives the money only if the primary beneficiary is no longer here. That is why, by assigning charity on both RIFs as a contingent beneficiary, you make sure that if either one of you passes away, the surviving spouse receives the balance tax-free. But when the last spouse dies, the charity receives the remaining RIF balance, and the charity issues your estate the tax receipt that will offset any taxes payable on the RIF balance. That's a great option for those who want the leftovers of their RIF donated to charity entirely. But what if you want to achieve some balance and make sure that your children also get some money? Then we have option number 2. You simply buy a life insurance policy for the fraction of the money that your estate would otherwise pay in RIF taxes. You make your children and grandchildren the beneficiaries on that life insurance policy, and at the same time, designate Kuching Conservancy or any other registered charity as a contingent beneficiary on a RIF, not on the insurance policy in this case. When the last spouse dies, children receive the life insurance payout tax-free because they're beneficiaries. Kuching Conservancy receives the remaining RIF balance and issues a corresponding tax receipt so that the state will not pay any RIF taxes. This option requires some financial planning to select correct life insurance type and amount, but any philanthropy-focused certified financial planner can do it for you. Now, before we go into option number 3, let's just for a moment get back to that option number 1. Let's say that your children and grandchildren inherit your house, your cottage, your other assets, and you want your charity to get the entire remaining RIF balance. When you simply assign the charity as a contingent beneficiary, it's good enough. But you still could increase that gift without adding any extra money, simply by using the power of life insurance. Do you remember my original example in the beginning of the presentation when 60-year-old lady could donate $60,000 to $70,000 over her lifetime in cash, but instead she purchased $104,000 life insurance policy? This idea, combined with the RIF donation, could be brought to absolutely next level of tax efficiency. You simply buy a life insurance policy, assign it to your favorite charity, and you pay the premiums on this policy using your RIF withdrawals. Under normal circumstances, your RIF withdrawals are taxable. However, the registered charity will issue corresponding tax receipts that will offset the extra taxes. In many cases, the tax break could be even higher than the required tax payment on RIF withdrawals. So you'll receive additional tax credits that you could use to offset taxes on any other types of your income. But some people might say, wait a minute, how about the withholding tax that bank charges me at the spot, even before I get that extra RIF money deposited to my checking account? Well, there is a way about it. You could use the government form T1213. You fill it in, specify that the extra withdrawal is to be used for charitable purposes, and CRA will grant the permission to your financial institution not to take the withholding tax. I understand that it might sound complicated, but believe me, the tax efficiency is worth it. In my professional opinion, as a financial planner, say fixing a garden shed with 15 or 20 nails would be much more dangerous and complicated task than that. Well, but seriously speaking, the point of my examples is to show you that you have a choice. You either allow the involuntary philanthropy by paying taxes, or you enhance your generosity towards Kuching Conservancy or any other registered charity. Surprisingly, CRA will be happy to support you with that. They will be on your side. As Candy said before, in Canada, we have one of the most generous taxation regimes when it comes to charitable giving. Whether to take advantage of it or not is your choice. On this optimistic note, I would like to pass it over to Candice to summarize our presentation.
Thank you, Vlad. And if we go on to the next slide, we covered a lot of things tonight. And so we thought it'd be useful for a summary here, just to make sure that the key points are hitting home. And so remember, your estate will participate in philanthropy, whether you want it to be or not, because it could be government allocated or it can be purposeful through your own charitable intention. So remember to make it voluntary, but that does require a little bit of planning there. So next time you donate cash or credit card, consider using donations of appreciated securities for a double win. And remember, if you're donating from a corporate setup, it's going to be a triple win. And now, remember, you can create your own family legacy through a donor advised fund or private foundation structure. We already have a question in the chat about it. We can address it again to the group later on. And use life insurance donations to supercharge the gift for your estate and your charity. There are unique features of segregated funds that make them perfect for estate planning. So definitely talk to your financial planner to talk about that if it works for your situation, and consider effective estate planning strategies, combining your RRIF withdrawals and incorporating it into the life insurance side as well. So at this point, I would like to pass it back to Tanya for Q&A and facilitating that. But thank you for your attention and time. We look forward to having this further discussion with you.
Thank you so much. I know that was a lot of information and really, really interesting. And I love that, that saying, Vlad, you said something about generosity explosion when you pass away. I'm like, that's really interesting, like a nice way to say it. Yeah, so there are a few questions in the chat. So, and I think that Bob can chime in if he needs to as well. Does CC&L have donor advised funds?
So yes, we do, and we use Canada Gives as the administrator of the donor advised fund. But just to also give a bigger perspective, there are a lot of donor advised fund administrators in Canada. I'd say there's over 20 that are very good. Canada Gives is just one of the options that we have. It is very personal to each client's and donor's journey and situation before we would even sort of consider and talk about where the donor advised fund can be housed, because it could be, for example, with the Aurelia Community Foundation, it could be with Toronto Community Foundation, Abundance Canada, Canada Gives is another one. So there are a lot of them, and each one is a little bit different. So that's a way, and actually Mackenzie is another one. I know Vlad uses Mackenzie for his clients too. So there's just different offerings that each one provides. So I think when you're considering a donor advised fund, you just need to explore all the different ways that it can be done.
Right. There's a question about the contingent beneficiary and if more than one charity can be named.
Yes. You can have as many primary beneficiaries as you want and as many contingent beneficiaries as you want. However, it's what I told you is it's legality. Unfortunately, reality sometimes is not as rosy. There are some financial institutions that do not allow contingent beneficiaries at all for some reason, even though it's legally possible. There are some financial institutions that do not allow multiple contingent beneficiaries. If that's the case and you want to have few charities as contingent beneficiaries, which I completely understand, you just have to find a financial provider who will appreciate your money and allow you flexibilities that you deserve. And they do exist, I know them.
There was a question submitted when someone signed up asking, what is the threshold where you pay half your RRSP in taxes?
I am tempted to give a legal answer to this, which is it depends.
Right.
Because it really depends on your personal taxable circumstances. Generally speaking, it's not just RRSP or RIF. It is more of your total taxable income for a year. And if you think in the year of death, when it comes to the estate, it's actual income that person received. It is RRIF balance. It is capital gain on cottage and other investments, and could be a few other assets also. So when it all combined, basically highest marginal tax rate, I don't remember to the exact dollars, but it's somewhere, it is reached somewhere towards $240,000. So if your combined taxable income in 1 year exceeds that amount, you're facing 53%.
So best.
Yeah, I would have the same sort of response as the clients I've worked with. It's usually around 200, 300,000. But yeah.
Yeah, it's a bit higher than 200. I just don't remember exact number, but it is crossed like that in the estate. Average estate crosses it very easily.
Mm-hmm. There's a comment in the chat saying, speaking from family experience, it was not nice to write the big check to CRA in year of death when there was a large RIF RRSP balance.
It's very shocking to a lot of people. A lot of people don't realize that. So hopefully the planning will help out.
Yeah, absolutely. A few more questions. We have 10 more minutes, so that's okay. The charity I wanted to donate to said that they couldn't receive shares of stock. What can I do?
So this is could be common amongst the smaller charities. And I think in that case, you should ask them if they have an affiliation with a community foundation. A lot of the times they do. And then the community foundation can help facilitate it for the charity for free for the most part. They usually don't charge anything to the charity. Another way is through Canada Helps. And the Canada Helps way, there is a 4% charge for the donation, but I think I've heard of banks taking like 20% plus in fees. So the 4% sounds like a deal when you listen to it that way. So smaller charities also use Canada Help. So there's sort of those two ways that are the most common, but I would definitely ask if they have a community foundation that's helping them first, because they are very willing.
Mm-hmm. Yeah. A comment from Doug Vardy saying that the Aurelia Community Foundation will do this at least for larger amounts. Yeah.
That's correct.
Yeah. Another question is, I tried to add a charity as a secondary RRIF beneficiary, but my bank said that they cannot do that. Why is that?
Well, I think I just addressed it answering the previous question. I don't know why they do that, but they sometimes do.
Yeah.
Just find another financial institution. That's that simple.
Yeah. I think there's one more question. I'm a single person. I like the idea of donating a life insurance policy to Kuching Conservancy, and I don't care about the estate tax credits. How can I receive charitable tax receipts for monthly insurance premiums?
A very good question. In this case, you actually have to assign life insurance policy to the charity. Charity should become the owner of the policy. It's not enough just to mention Kuching Conservancy as a beneficiary. It should also become the owner of the policy. And you, as a donor, you will be paying into this, and at the end of the year, charity will be giving you a tax receipt on the annual amount contributed. So it will be just like a regular donation, which is, I expect that's what you want. But of course, the overall impact to charity will be magnified with life insurance policy.
Wow. There is one more. Is it easy to open up a donor advised fund, and how do I get started?
So yes, it's very easy. Usually it's a 2-page process to sign up. It gets opened up the same day. And the longest part of the process is however long it takes to fund your donor advised fund. So I've had clients who were rushing to open it on December 28th because they weren't very well prepared and planned for their taxes and realized they wanted to do it in that calendar year. And we're able to do it in time for year end. So they use a cash donation for that. So that's the fastest way, of course, for the money to receive your donor advised fund. But the slower one would be if you're transferring appreciate securities into it, then it could take, 5-10 business days. The banks actually have up to 30 business days to do that part of the work. So if you're ever trying to rush for the year end, definitely plan at least before November.
Yeah, good advice. Bob, I don't know if you had any questions that you wanted to add as well.
No, I think the riff area that Vlad covered was really got it sort of brought it to the right level in terms of understanding. And I think the bottom line is that with advice, it's a win-win for the charity, and it's either the charity or the government. And I think most people would prefer the charity gets the money. So I think Vlad brought the riff part to to that right level of understanding. Then we need advice from that. So I'm good. Thank you, Tanya.
Great. And it's interesting. You're both. Let me find it again. You both have your certified. What's it called? I'm trying to look back. You're a certified financial planner, gift planner. And everyone that's a financial planner doesn't necessarily have that, right? So you have extra knowledge that you can help your people with. So
Well,
yeah, it's a newer designation out there. It's a Master Financial Advisor Philanthropy. And with the whole Willpower campaign coming out in the fall, it's actually going to be extremely exciting for charities. But the other thing is that we're both very dedicated to the gift planning side of the business. Being a member of CAGP, Canadian Association of Gift Planners, it is a big focus of how we want to help our clients. And you're right, there's not that many advisors out there that do that. So.
Yeah. Well, thanks so much. I think we got through all of the questions, and thank you so much to everyone who attended tonight. If anyone here has questions specifically about the Conservancy, always feel free to reach out to Mark, our Executive Director, or myself. The members of the Past President's Council that help with the Heartwood Fund are also able to have a conversation, and of course, talk to your financial advisor and make some plans. And again, I just want to thank Candace and Vlad so much. This was really interesting, and happy to share this information with our supporters.
I'd also like to follow that up with a thank you too. It was enlightening, and it just opens more doors for everybody. I think that's the benefit of the seminar, is to really broaden the horizon and broaden the opportunity. So thanks, Vlad, and thanks, Candace.
Thank you, guys.
My pleasure.
Yeah, if I could just add my thanks as well, Candace and Vlad. I thought that was excellent. I sat through a few of these, and I thought it was very well done, and we really, really appreciate your time. So thanks again.
Thank you, everyone.
Thank you.